Hello and welcome to this episode of Mic'd Up. I'm Pete Seyler, a part of our business development team here at iCM. And today I'm joined by Nina Liu, portfolio strategist at Principal. Nina, thank you for joining us.
Thank you for having me.
All right, so why don't we start at the beginning, just because investors hear the term real estate or REIT, and the first thing that comes to mind are residential housing or private investment vehicles with high dividends but often limited liquidity. Can you just give us really a high-level overview of the publicly traded REIT asset class?
Yeah, absolutely. So, publicly traded equity REITs or real estate investment trusts are companies that own and operate income producing properties. So, these can range from some of those more traditional sectors, like you mentioned, like multifamily apartments or malls and office, to more niche sectors like cell phone towers, data centers, even healthcare facilities. So, these niche sectors actually, they make up the majority of the US REIT universe today. And these are sectors that continue to benefit from many structural drivers, such as mobile data demand, AI demand, and our aging populations. I think what makes listed REITs really unique is their ability to offer immediate and diversified exposure to real estate, but with the liquidity of public equities. And since we're talking about contractual leases, and so very visible cash flows, plus there's a favorable tax structure where REITs must distribute the majority of earnings as dividends, REITs actually make for a very compelling source of income as well. I'm going to share my screen here because I want to show that in many market environments, this makes REITs a great diversifier in an investor's portfolio. The best way I can show that is with some correlation data, particularly given today's environment. I think many investors assume that since public REITs are equities, they'll move in tandem with equities. And while that can be the case in the short term, if you look at the right chart, the longer that you hold a reallocation, the more it actually starts to act like underlying private real estate and less like equities. And today, if you look on the left chart, as the MAG 7 continues to dominate and perhaps feel a little over concentrated in many portfolios, more defensive REITs are offering historically low correlations relative to other areas of the equity market. I think that's really highlighting the diversification potential of the asset class.
All right, so let's stay there for a second. A lot of us are either homeowners or prospective
Mhm.
homeowners, and we've seen residential housing prices really skyrocket since the pandemic. REITs really kind of have struggled.
Mhm.
What are some of the major headwinds the asset class faced?
Yeah, so maybe for first, it's worth highlighting how REITs have historically served as pretty powerful total return engines over the long term. So, over the long term, since 2000, REITs have delivered very strong risk adjusted returns that's supported by those durable income streams I mentioned, those inflation linked cash flows, and those structural demand drivers. But you're absolutely right. The last few years have presented a much more difficult backdrop for real estate. Really, this comes down to a persistently rising rate environment, which unsurprisingly puts pressure on longer duration asset classes like REITs. So, this headwind, paired with the strong outperformance of large cap tech and broader equities, has led to REITs having meaningful underperformance these last few years. But with that being said, we think that just shows REITs have repriced and are looking increasingly attractive after being out of favor for a few years. One thing I
Okay.
want to follow,
Oh,
maybe one
sure,
thing I'll
please.
follow up on, since you mentioned residential housing, and that is so top of mind for so many people. You're absolutely right. Housing prices have been pretty strong despite mortgage rates increasing the last few years. Typically, you see the vice versa happening. Well, prices have remained really elevated because there hasn't been a lot of new supply hitting the for sale market. Consequently, you're seeing that the all-in cost, the monthly cost of buying a house has become significantly higher than renting, almost a
Sure.
30% premium. I think that really highlights the affordability gap in favor of renting versus buying today. And that's a structural tailwind that has actually benefited REIT sectors like multifamily and single family rental in recent years.
Okay, so let's keep on this track a little bit. What are some of the key traits of environments where REITs have done well? How does that align kind of with where we are today?
Yeah, if I think about the recipe for where REITs have done well, uh, it's really two important ingredients that we're seeing already today, one being cheap valuations and the second being positive fundamentals. A third and often the most important ingredient has been missing the past few years, and that's been accommodative interest rates. So let's narrow in on that factor and maybe take a look at the relationship of REITs and yields over the long term. So historically, REITs have been, first of all, able to deliver positive returns in actually both falling and rising yields. Negative returns have happened typically when the Fed has been hiking, like you've seen in recent years, as you can
Hmm.
see more in that bottom right quadrant of what I'm showing here. Or when REITs have been under pressure when there have been more major financial crises, which affect all risk assets, as you can see in the bottom left quadrant. However, we're now in a situation where the Fed has restarted the rate cut cycle with a cut in September, another in October. They're closely watching inflation and softer labor markets because they have to meet their dual mandate. That's very difficult. But there have been indications of future cuts to come. So if you look at the top left quadrant, Fed rate cuts have historically been a positive catalyst for REIT returns. So historically in this period, US REITs have averaged total returns of over 9% once the Fed starts cutting rates, generally outperforming overall US equity markets. So rate cuts would definitely be a positive, but strong fundamentals are equally as important as well. So if I think about the last few years, or pre the last few years, real estate had really taken advantage of those ultra low borrowing costs from pre 2022, and they had been aiming to develop and add to their supply pipelines. Well, this ultimately led to a bit of an oversupply in certain sectors like industrial and like apartments. This oversupply has since come down to create more favorable supply demand backdrops, which can lead to strong earnings growth and pricing power going forward. So that's another positive thing as well.
Got it. So you may or may not know at iCM, we manage a global tactical asset allocation model, and all of those tactical decisions are based on valuations. Let's put REITs in perspective in terms of the valuation environment. What are we looking at today?
Yeah, I already gave a bit of a teaser in the earlier question, so I'll keep this quick, but really attractive valuations are that third point in the trifecta benefiting REITs today. So here, if you look at price multiple spreads of US REITs relative to equities, REITs are trading at historically cheap levels. The last time you really saw it, unfortunately, you can't see it in this chart, was in the early 2000s, where REITs then proceeded to outperform equities for a pretty extended period of time. So ultimately, today is clearly a very attractive entry point into an asset class that has both those solid fundamentals I mentioned and that potential for a rate cut catalyst.
Great. So let's bring this home. You and the team at Principal take an active approach when managing REIT portfolios. How are you positioned today? Are there any specific sectors that look particularly attractive or particularly unattractive?
Yeah, I'll put this a little bit of a table showing where we see relative opportunities today, and I'll mention a couple of them. But just overall, here at Principal, we're taking an actively managed bottom-up approach when we're managing our REIT portfolios. So today, we're currently overweight to sectors with more resilient demand and growth characteristics, like senior housing within healthcare and single-family rental within residential. Maybe I'll highlight senior housing particularly because it's really a sector experiencing a golden era following its post-pandemic correction. So since 2021, the sector has seen steady improvements in occupancy and demand driven by an aging population and limited new construction that has limited supply. So that has all led to rental growth that's solidly in the double digits, which is great. The tenants themselves in these senior housing facilities are really fundamentally sound as well. If you think about senior populations income, there's been significant growth. They've benefited from their own home price appreciation, all boosting their own balance sheets, and ultimately their ability to afford these senior housing leases. I think this should all drive continued demand across the full spectrum of senior housing and senior care over the next decade. And maybe I'll go on the other hand and say we're more cautious on a sector like retail. So, despite consumers remaining pretty resilient over the past few years, we think there are some tariff concerns that could still impact the sector, and we think valuations look a little bit full compared to other areas of the market. So that's one area that we're more cautious on. But maybe overall, we just characterize our positioning as having a preference for quality companies, and we do expect the portfolio to be positioned well for market conditions ahead.
Great, Nina. Nina, thank you for joining me today. I really appreciate it.
Yes, absolutely. Thank you for having me.
Outstanding. And for our viewers, if you have additional questions or would like to suggest a topic for a future episode of Mic'd Up, please reach out to us at 888-426-4689 or via email at info@icm-invest.com. Don't forget to subscribe to this channel for early access and notifications of new content as it's posted. Thanks for watching.